perhaps we would have tariffs that were existing on China either partially removed or completely removed, and then there is another set of tariffs set to come in on December 15th, and there was some hope that that wouldn't happen. The president's basically said he hasn't made up his mind, and that's a good negotiating tactic. I don't think anybody's terribly shocked about that. There's some very high-level discussions now at the very highest levels with the Chinese, and I don't think he wants to give away too much until the last minute. So this is a real delicate game. So remember, people ask, why are we at new highs? What the three movers of the market have been, marginal movers of the market this year. One is tariffs and trade, and the market continues to be optimistic about this. Tariffs are what matter more than even discussions on intellectual property. All that does matter, but for the markets, tariffs impact earnings, and that's what impacts the stock market. So when you hear about tariff headlines, that's really what's going on, even though there are broader discussions about forced transfer and intellectual property with the Chinese that are important. It's the tariffs that move the market. Second mover is the Fed. The Fed is neutral now. They're going to come in and cut rates if they need to. Other than that, they're neutral. Market's fine with that. And then third is slower global growth and the impact on earnings. And the question is, how much slower is global growth? We had some very good numbers last week. U.S. jobs better, China manufacturing better than expected, Eurozone GDP a little better than expected. This is not a start of an avalanche of better news, but at least there may be some kind of bottom in the global slowdown story. So you put these stories together, optimism on trade, tariffs, Fed being neutral, and maybe global growth story in 2020 not as bad as feared. That's how you get the market at new highs. What else do we want to talk about, Laura?
A lot of people talking about the streaming wars. Who is winning the streaming war, Bob?
Oh, boy. Who's winning the streaming war? So look who we've got here. We've got Netflix involved. We've got Amazon involved. We have Hulu involved. Hulu's controlled mostly by Disney at this point. And we've got Apple, who's getting into the streaming wars. And then we have Comcast, which is introducing their own streaming service. Disney's going to introduce their own streaming service. So who's winning? An awful lot of people are throwing an awful lot of money at this. Netflix still spends more than anybody to build new shows, but Amazon is catching up, and Apple's spending an awful lot of money as well. So if you buy an iPhone now, you get Apple TV with it. If you buy Hulu, you'll get Disney Plus, or at least a discount on Disney Plus. So I'll tell you what my concern is. I don't know who's winning long-term on this because it's a little bit early, but what I see is subscription fatigue. So if you think about how many people are actually going to keep subscribing to all this stuff on top of cable, there's a limit, and there's a lot of debate about how big the limit is. There have been studies out that indicate that most people can handle 3 or 4 subscription services. If you think about this at, figure $10 a month, and beyond that, they can't watch, or they don't want to spend that much money. Think about spending $40 or $50 a month on subscription. You're back to the old cable model here, where you're spending $100 or $200 a month. So I think there is some subscription fatigue that's going to set in. There's questions on how far it is, but think about maybe 4 for an average person. What I have always felt the solution to this is, and I don't think the services want to do this, is micropayments. So suppose you want to watch some service, some show on Amazon, and then you want to watch another show on Apple. Why pay for the whole service? Why not have a micro service where essentially it charges you $1 to watch that show that week? If you want to watch the whole season, it'll cost you $4, but you don't have to buy the entire subscription service. You can get any show you want. It's sort of like, going out and buying things individually with a credit card. You're not paying to be on one service. You're just paying to buy that one thing. This would be great for the consumer, but I don't think the companies themselves are really in favor of that, and I think that's one reason micro payments have not caught on. I personally think, though, that's the ultimate solution. What do you think?
That's really interesting, Bob. We have a more technical question of the stock market. Why does the stock move differently on 2 different exchanges?
Oh, that's a good question. Why do stocks move differently on 2 different exchanges? So you have what's called dual listings, and what happens in a dual listing is, say, a company that lists in London, pick Barclays, for example, can list here in the United States at the New York Stock Exchange or at NASDAQ. Companies do dual listings for many different reasons, but largely it's because you want a broader ownership base. So the ownership base that's maybe in London that would own stocks is not necessarily the same as the ownership base in the United States. So broadening out is a good thing for most of these companies. You can get different prices for these stocks simply because there's different supply and demand dynamics that happen, say, in the London Stock Exchange on any given day and the New York Stock Exchange. But because the companies, the prices are theoretically related to each other, you get these what are called arbitrage opportunities. So, for example, if stock A is trading in London up 1%, logic would demand, if you're dealing with the same company, that the stock would trade in a similar pattern here in the United States. So if it doesn't, you get what are called arbitrage opportunities, where professional investors come in and buy one and sell the other to get the price in an even way. Sometimes this will happen where you get unusual moves, where you get wider disparities, and in theory, the market comes in, steps in, and deals with it. This is an interesting question, by the way. Alibaba has announced that they're going to list in Hong Kong. This has been talked about for months. Alibaba lists here at the New York Stock Exchange, and it's a huge stock, $500 billion stock. They announced what seems like a very modest listing in Hong Kong, maybe 10, 11, 12 billion dollars. That's pretty small for a listing. But they have, why would they do that? Well, there's a number of reasons. Number one, they want to expand their ownership base. There's 600 million Alibaba users in Hong Kong. In China, in mainland China. They don't have access to the U.S. market necessarily, but they would over there. So I think Alibaba is very cleverly deciding, gee, we got all these users over there. A good percentage of them, even if only a few million, would want to own our stock. If we float a very small amount, think about that, $10 billion, a pretty small amount for a $490 billion company. The demand may be pretty high. The price may go up. The price goes up over there. The price may go up in the United States, or should. And so you get that small stock over there sort of wagging the bigger stock that's over here, wagging the body of the bigger stock that's over here. That doesn't sound crazy to me if the interest of Alibaba is to get their stock price up. Alibaba has been a great performer, by the way, since they started talking about having this dual listing, and that's what it is, it's a dual listing. In May, the Alibaba stock has outperformed the U.S. stock market. It's outperformed the Chinese stock market. So there's some evidence, if that's their theory, it might also work. Another reason why they might want to do a dual listing, besides expanding their ownership of their stock, is maybe as a buffer. Remember, U.S.-China trade negotiations get a little rocky. You never know what's going to happen in the future. Maybe they want some backstop in case something goes very sour in U.S.-China relations. To fully trade their stock in Hong Kong. Nobody has said that. That's just me talking, but that may not be such a crazy idea as well. Laura, what else?
Bob, a lot of people are asking questions about earnings season. I know it's winding down, but we have retail coming up. Is there something to watch for there?
Yeah, so we're getting the tail end of earnings season, and that means retailers. And the reason retailers are the last ones to report is they have a reporting season that is usually a little bit off from the rest of the earnings season, and the reason that is because of Christmas. So much of the retail is loaded towards the fourth quarter of the year that most retailers do not have their year that ends on December 31st. Most of them have a calendar year that ends in January 31st. So the retailers, most of them, are just starting their fourth quarter now, November 1st, November, December, and January. So that's why we're getting late reporting from the retailers, because their quarter just ended on October 31st. There is some reasonable hope for retail sales. The numbers, it depends on who you talk to, up 2-3% from last year. Last year was a pretty good year. In fact, it was a darn good year for retail. We all know what's going on with individuals continuing to switch to buying online. Most estimates I've seen is the total number of online sales versus total sales is 15, 18%, and it's growing a few percentage points every year. Everybody wonders when it's going to accelerate. But there are obviously some companies that are continuing to scale back. Sears, for example, announced more store closings. Gap's had a lot of problems recently. So I wouldn't be surprised to see further concerns But there are small groups of retailers that are doing really, really well. Home Depot, for example, the home improvement companies have been doing really well. The discounters, the Ross stores of the world, the TJXs, the TJ Maxxs of the world, they've had a very, very good year. So the retail market has split into a relatively small group of outperformers that are there, and most everybody else that are flat, and in some cases down big because their apparel is not in demand, or they're not making a successful transition to online, or companies like Amazon are offering alternatives that are cheaper in some way. So it's a very tough time for a lot of retailers right now.
So the last question, Bob, is a tough one.
Can we sustain global development in a slowdown? That's a very interesting question. It's a very broad question and philosophical. So there's a lot of debate about what's called the limits to growth. So in post-capitalist or late capitalist society, how much growth can you really expect? Here's one real natural limit: population growth. If you get zero population growth or negative population growth, ultimately, which is essentially what's happening in places like Japan and parts of Europe, where the number of babies every year is not enough to replace the population. So the way to look at it is a typically number that's thrown around is 2.1 babies per household, just to stay even in population growth. If you start dropping below that, long-term population goes down unless you have immigration, which is one argument for immigration. So the United States is below 2.1. Japan is very mid-1 numbers, like 1.5 maybe. Much of Europe, including Italy, is well below 2.1. In other words, they need to get immigration growth or have a lot more babies to keep the population growing. Why am I bringing this up? Because if you want growth, you need more people to buy stuff. You can either get people who are existing to buy more, or you can have more people buying more stuff. It's not that hard to figure out. Population growth is the classic way to get more growth. Seems kind of obvious. This is why, these immigration questions become very important. This is why cost of living, the cost of raising a child become very important. All of this kind of figures into the whole growth question. There's other independent of population issues. There's questions about sustainability of growth. This gets into the whole, what we call ESG, environmental, social, and governance issues. Do we want growth at all costs? Do we want 2 or 3% growth, even if it hurts the environment, even if the economy, the environment can't stand it? These are legitimate questions about growth in general. So I don't have a clear answer on that, but it is a very, very interesting, broad philosophical question, and I'd encourage everybody to go out and take a look at some of the debates that are online about the limits to growth. That's it for this week. I'm Bob Pisani down on the floor of the New York Stock Exchange. Everybody have a healthy, happy, and safe weekend.